Innovative Industrial Properties, Inc. is a leading legal cannabis stock that has grown like a weed since going public in 2016. As you can see, the stock has commanded a normal price-earnings ratio above 36.66 since it went public. However, since last year, November of 2021, the stock has lost more than half its market value, almost 70% of its market value. The question is this now becoming an attractive buy or is it a sell? I'm going to add AFFO, Adjusted Funds from Operations, because this is an industrial REIT, currently yields 7.39%. And you can see the valuation was very, very high in the beginning. However, the company was growing at 45.7. So using Peter Lynch's famed P equals growth rate formula and drawing a valuation reference line at a PE of 45.7, the stock actually looked reasonably valued during this growth phase. However, as I shorten the time frame, notice that the growth rate begins to slow down to 38.2%. If I drop it to 5 years, it slows down to 23.5%. As I go even further, it slows down to 16.9%. And as I go even lower, it slows down to 11.9%. The point being that this company's growth rate is slowing down. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I've got kind of an unusual stock to look at today. I'm going to look at Innovative Industrial Properties, Inc. The company claims to be the leading provider of real estate capital for the regulated cannabis industry. And it's a very, very interesting company that has some very unique characteristics that are very hard to find and very rare to find, I should say, as a common stock investor. And it is a hybrid, if you will, between a growth stock and a high-yield dividend growth stock. And those things normally are not able to be described in the same breath. You can usually find high-yield stocks that are low growth. You can often find high-growth stocks that have no yield. It's very, very rare to find a high-yielding, fast-growing dividend growth stock / growth stock. So let's take a look at this company and run it through the paces with the FastGraphs Fundamentals Analyzer software tool. Okay, so first of all, I want to start out, I'm going to look, since the company is an industrial REIT, I'm going to utilize FastGraphs and I'm going to go to the metric free cash flow or AFFO, or I'm going to look at FFO, operating cash flow. And both these metrics provide me very similar insights. I happen to prefer FFO because it's a more standardized measurement. AFFO is not standardized and can be, manipulated more. But in the case of Innovative Industrial Properties, I think both of these metrics appear pretty good. But now I want to illustrate how FastGraphs can be utilized to evaluate this stock by just looking at either one of these two metrics. So I'll stick with AFFO since it is also one that is, favored by a lot of analysts. So first thing I'm going to do, I'm going to shorten the time frame to 7 years here. And because I don't get a growth rate calculated because I've got really, a negative number starting out here in the first year. But if I drop that to 7 years and start by looking at this company starting at the beginning of 2018, they've grown their AFFO by 45.7%. So we've applied a 45.7 PE ratio to the stock, and you can see it traded at that value for the first couple of year and a half or so. And then we came into the COVID, and it actually got undervalued like a lot of stocks did, but it kind of moved back into that quote-unquote P equals 43.7 times, FFO, if you will, or, the basic formula that you would utilize utilizing Peter Lynch's recommendation of P equals growth rate, so a PEG ratio of 1. But then I also want to point out that because of these undervaluation periods where the PEs got down even into the teens during the height of COVID, it got down to 16, we had a normal PE over this period of time of about 36.66. Now, that's still a very high multiple relative to, what companies typically trade at in terms of, a 15 PE is kind of a good baseline PE for most companies. But when companies are growing at 45%, then, of course, that PE would be higher. Now, if I shorten the time frame to the last 6 years, I want you to notice that the growth rate drops to 38%. And the stock now, trades at a normal PE of about 33 times earnings, but also that 38%. So this is saying that, you can see how growth has achieved. Now, if I measure performance from the beginning here to the trough, this company generated a 90% annualized rate of return since January 4th, 2019 through 2021. 10,000 would have grown to 60,000. And that was actually, in my view, a justified growth rate, I think, because you're looking at the stock from a standpoint of, P equals growth rate and the fact that it was growing very fast. But the other side of this stock was it also paid a very attractive dividend yield during this whole time. And if I put the dividend yield on here, you can see that the dividend yield was, 3.7%, back in 2019. But now that the stock has gotten so cheap, that's ballooned the dividend yield to 7.39%. But let's stay with this growth factor. Now we've shortened it again. Now the growth rate's 23. So I want you to make sure you understand this orange line now has adapted to the P equals growth rate formula, in this case, price to AFFO growth rate. And we're seeing a PE ratio now being reflected by the fast graph research tool of 23.35. And we start to see now that the slowing down of growth is one of the things that I think that stimulated this rapid sell-off in the company. If I drop this to 4 years, now we've got growth of 16.9%, and now we're using the PE equals growth of 16.91. Now, the point is, I always believe that more near-term growth rates are more relevant than long-term growth rates, simply because, these 140% growth rates are obviously unsustainable, but yet they are achievable by a small company when a company is young and small. Right now, we have a current market cap of only $2.46 billion, total enterprise value of about $2.42 billion. One thing I do like about this company, it has relatively little leverage. It has a low debt-to-capital ratio of about 13%. And the dividends is extremely well covered by their FFO. So the fact that it is such a high-yielding stock is intriguing. But now when I go back to this low growth rate, when I run this to a 3-year graph, I'm kind of looking at what our forecasting calculators will show. And we've got about roughly, I'll call it 12% rounded, AFF growth rate for this period. So, and that would give it a PE ratio, fair value PE ratio of 15. And what we're doing is we're adjusting the valuation metrics over time to what the expected growth is. So let's go ahead and look at the forecasting calculators. And what we see now is an expectation for 12.26% growth, but that includes a 24% growth rate this year, followed by 7 and 4. Okay, but we are seeing the blended price to AFFO at 12.34. So I think a 15 PE ratio is a very rational valuation metric for this company. Now, it's one of the highest quality cannabis stocks out there, and it's a REIT. And I think it's conservative in terms of its financials and so on. But the point is, if I use this as a conservative benchmark, you can see the rates of return out through 2024 would be over 20% a year annualized, with a very healthy 7% dividend yield that is expected to be increasing over the years. Now, if I look at the past historical performance of this company by going back to the historical graph, just to give you a perspective, and run it out to max and then run performance here, I want you to see that the dividend has grown at a rather astounding rate, but notice that the rate of dividend growth increases has also slowed down as the company's pure growth rate has slowed down. All right, so, that's something to take into consideration. But going forward, the analysts are expecting about 12.2%. The long-term growth rate by these analysts is expected to be 10%. Now, at this point, I want to illustrate some other things that you can do with the Fast Graph Research tool. You can go into these external links, and you can go to Seeking Alpha, which I'll cover. You can look at Morningstar, Wall Street Journal, other sources of information. Researching stocks is difficult. And Fast Graphs, I believe, represents a great first step, but it's only the first step. You want to go further. One place I like to go is to the company's website, and I'm going to go right into here, into Investor Services, and I'm going to look at all events and presentations. And there was a presentation on August 24th, 2022, that I want to bring up here that was basically a presentation that the company presented, because this will give us what guidance was. Now, they talk about when they were founded in 2016. They talk about, their structured long-term cash flows, their strong initial rental yields with annual escalations. They talk about all the growth that the property's done. I'm going to let you review this yourself. But the one thing that I want to basically emphasize here as I go through this, the company suggests about a 12% average 5-year estimated cannabis sales growth. Okay, now that number there, I think, coincides with the analyst expectations for AFFO growth. But in this case, I also want to point out a couple of other things about these estimates. Number one is if I go to the 12% number that we're looking at here, I want you to note that analysts have been slightly increasing their estimates for 2021. In 2022, they slightly decreased their estimates from 871 to 829. And then they've also decreased their estimates for 2023 from double-digit $10.57 of AFFO down to $8.92, and they went from $12 in AFFO to $9.34. So analysts are getting, I guess, a little less optimistic about the company, but this 12% number is consistent with what the company has guided and projected. So you can simply use this here, or I think it'd be a little more precise to go into the custom calculator. Let's forget about historical growth here, because historical growth is crazy. And, it's unsustainable. So if I go to the custom calculator here and input 12% growth, which is what the guidance is, and then draw this graph using the 12% growth number, you could see that I would have a long-term potential of about 20% a year, double-digit rates of return, with a very healthy 7.39% dividend yield currently, probably a little higher than that because the stock is actually down precipitously today. You saw it was up 6.29 or almost 7% yesterday, and then that follows today. We'll go to Seeking Alpha here. That follows today by being down 5.5%. So, the stock is very, very volatile now. One thing about going to a research terminal like Seeking Alpha is you can get a lot of articles and a lot of good news on the company and what's happening, in addition to going into the company's website, and I highly suggest that. But I think based on what I'm looking at now, industrial properties looks like a very attractive long-term investment because of these prices. Now, it was valuation driven, but the valuation with a twist here, because I don't think the stock was actually terribly overvalued when it was going through this very fast growth phase. It wasn't until that valuation started to reset, started to get lower and lower, that we saw this reset of stock prices, a 70% drop in the value of the stock roughly, since November of last year. A 65% drop, and plus dividends, it came out to about a minus 67% annualized loss since, in 1 year. But that has brought the stock into what I would consider to be attractive valuation now. Now, if I'm researching the stock and I'm using this research tool, the next thing I want to do is I want to go into the financials, and I want to go into fiscal fitness. Now, I'm not going to use the free cash flow to dividend. This is a thing that we're developing on FastGraphs because we're using free cash flow to equity. And what I want you to note is if I look at this company from a standpoint of the historical FastGraphs, and I look at free cash flow to equity, you'll see that free cash flow to equity hasn't really been that good. But if I'm using the free cash flow, standard free cash flow, which is the FFO number, I've got a really good number. So here, I'm simply trying to determine if the dividend is well covered, and I think it is, and I think it's expected to continue to be. Operating cash flow growth, or AFFO growth, has been very, very strong at over 32% a year since 2016. One thing to be aware of using this fiscal fitness tool is that the company has been very dilutive. That's very typical for REITs and even many MLPs. They're often raising, selling stock. Now, these were all good stock sales, in my opinion, because once again, if I look at the valuations of what they were raising money, increasing their stock, they were selling their stock at a very, very high level. Now, they may continue to do that going forward. However, that could be a negative, but it's also a positive, because the other thing that this has done, let's jump right to sales and revenues. You can see the revenues have increased dramatically. at a compounded growth rate of over 260% a year. Now again, that's expected to slow down, but that's a tremendous growth rate for this company. Their debt to equity ratios are very low, with at 0.2%. The company generates interesting margins, but it's really hard to look at those margins based on the years we're looking at. If I shorten the time frame here, you can see that they have very high operating margins and actually very high net margins. And this is the industry standard, the black line. They're generally and currently above industry standards on their margins, which I really like. The company does generate high returns on assets. The company also does generate high returns on equity, and they also generate high returns on invested capital. Now, you can also, with FastGraphs now, go into the financial statements full, and you can look at things like look at the company's balance sheet. And I'm not going to spend a lot of time doing that with you on this video for sake of time, but you can go in there and look a lot deeper. Remember, you can expand these balance sheet items out or collapse them here if you're looking at it. But you can go through the income statement, the balance sheet, and the cash flow statements, and learn a lot more about this company or any company when you're utilizing the FastGraph research tool. So in summary and conclusion, I believe this is a very interesting stock in that it provides an opportunity for very high yield with a very high dividend growth rate, as I showed you earlier, and it still has double-digit growth potential. Even looking at, the future years here in the custom calculator going back, utilizing that company guidance of 12%, I think this company is really a unique hybrid. It's a very fast-growing dividend, high-yielding company, and I find that to be very, very rare. That's what makes it interesting and makes it unique. The question is, can they continue to maintain their growth? I think there's plenty of growth if you're utilizing these conservative projections, and if you're ever going to invest in this stock, I think it's a good time now. And if you had invested in it in the beginning, I do want to show you something else. I've often said that you can't pay too much for a fast-growing companies. If you bought this stock essentially when it opened, where they weren't earning any money here, at around a $19 price tag and held it to today, you'd still be averaging over 37% a year compounded, and that's despite the fact that the stock has fallen more than 70%. So if you were an investor during that period of time, and you still own the stock, I would suggest that if there was ever a time to add more, now would be the time. I don't think you're going to see the historical type of, results that this company generated in the past. And, you can measure that as you see here. I'm doing it with my FastGraph tool. You can see what the tremendous, growth rate this company achieved. Should you or would you or could you have sold it? If you were running this stock, if you were using this tool correctly, it would have alerted you that you were seeing a slowing of growth and you were still seeing very high multiples on the stock. That could have given you a chance to get out if you wanted to, but actually if you hadn't got out, now might be the time to be adding more because you're getting almost a reset back to a very, very attractive valuation. Anyway, this is my take on innovative industrial properties. I think this is a speculation, but a very attractive speculation. It doesn't have a credit rating because they haven't applied for one. It's still a very young company. It still has a lot of room to grow. At valuation levels now, I'd stop short of calling it conservative, but I would call it a rational speculation at these prices here with a very high dividend yield. So any of you who are looking for dividend growth, this might be just the ticket for you. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this video. If you did, you might also want to take a closer look at FastGraphs because I've tried to illustrate how useful this tool can be to helping you make good long-term investment decisions. And if you did like the video, ring the bell, give me a like, subscribe to the YouTube channel, and of course, take a look at FastGraphs. I couldn't even imagine investing in stocks without the benefits that this powerful tool provides. Thanks for watching.